If you're a business looking to grow more sustainably, you may find yourself heading down the path of private equity to diversify your offerings, reach new customers, and receive expert insight about how to maximize your potential. Today, we will tell you benefits of consulting for equity. Number 11. Benefits and risks of consulting for equity. Taking equity is a complicated matter. It's wise to hire a seasoned lawyer and a sensible accountant. First, ask your lawyer if you're able to take equity. Also, know that some states impose security regulation exemptions. However, most states also have exemptions for companies offering less than 25 people an equity agreement. One of the misconceptions pertaining to equity agreements is that there's no cost when taking equity. This is untrue because when someone is issued shares in a company, they'll have to declare its value and pay taxes on it. When a company is in its early stages, the value should be nominal. However, once the company starts generating revenue, the value could be more than anticipated. Also, both parties are going to incur additional fees as they relate to legal and accounting. If your equity begins to vest over time, ask your accountant about filing an 83B. When someone files an 83B within 30 days of receiving equity, it allows them to pay taxes on the upfront amount rather than its vested amount. 10. Investing in a good startup lawyer and accountant. Taking equity is complicated. Find a good lawyer, we love ours, and accountant, and make sure you talk to them. Spending the additional time and money upfront can pay dividends, pun intended, down the road. 9. Legality. You should check with a lawyer to see if you are able to take equity. Check your accredited investor status and note that there are specific securities regulation exemptions based on the state in which the company you are investing in must comply with. However, most states have exemptions for offerings to a small number, less than 25, of people and also for employees or consultants exchanging goods or services. 8. Costs. A common misconception is that there is no cost when taking equity. If you are being issued shares or a membership interest in a company, you will need to declare the value and pay taxes on it. If the company is early stage, then the value should be nominal. If the company has already raised funding, even from friends and family, or is generating revenue, then it may be greater than you expect. The company should be able to provide you with the valuation for any equity they issue to you. There are also additional costs related to legal, accounting, time, and effort to consider as well. You don't want to do all this work and then have a $40,000 tax bill from the equity down the road. Number 7. Vesting or 83B. If the equity you are receiving vests over time, it is important to consider filing an 83B election. Filing an 83B within 30 days of receiving your equity can allow you to pay the taxes on the full amount issued to you upfront rather than as it vests. This prevents the large tax bills that would arise if the company's value increases sharply prior to being fully vested. 6. Equity versus options. One possible way to avoid initial upfront taxes is by receiving warrants or options. By setting the strike price of the warrant equal to today's market value, the warrant essentially has no value today. Only when the option is exercised and the value of the underlying equity is greater than the strike price do you earn and pay taxes on the difference. The downside is that you will have to pay a full tax rate on your profits when you exercise the option, as opposed to have a much lower capital gains rate if you had taken equity. 5. How can a private equity consultant help your business? Provides additional working capital as you receive new funding from investors, shares relevant industry connections and networking opportunities, diversifies business by integrating new processes and hiring high-quality talent, reduces overhead costs as operations are streamlined, assists with the development of new products and services, integrates stronger risk management strategies from rework of infrastructure and systems, provides expert insight into growth strategies and deal-making. Private equity can offer a wide range of benefits to businesses and investors, many of which we've discussed above. Here are 3 of the biggest advantages. Less volatile markets, returns that are way better over time, freedom from some public regulations and restrictions, access to alternative capital for underperforming or undervalued companies, focus on overall growth instead of quarterly performance. 4. How much equity should you receive? This is always a tough question. You don't want to take so much that you are limiting the company's ability to raise money or attract future employees. If you are not a full-time hire, don't expect to get more than a percentage point or 2, and typically much less. Try to value your services as a cash rate and compare that to the value of equity you are negotiating. Make sure to discount the value you assign to the equity in this calculation to account for the many years it will likely take to become liquid and the very high risk that it never will. 3. How do you earn money on your equity? The most common cases will be when a company has an IPO, is acquired, or raises a round of financing where the founders take money off the table, sell their equity. If the company is an LLC, then typically any cash the founders take out needs to be distributed equally among its members, i.e., you would earn a percentage of the distributions. LLCs can be really flexible though, and it is possible for the majority owners to change this. Be aware that if you are a member in an LLC, you will have a tax obligation on the profits or losses they record. They need to issue you a K1 at the end of the year that breaks down your share of profit or loss. So at bare minimum, you should ask that the company covers, via cash distributions, your tax obligations on profits recorded. Most companies provide specific language in the company shareholder or operating agreement limiting your ability to sell or transfer your interest. However, most often, you can ask for tag-along rights. If the company sells shares, you can opt into selling the same percentage of yours, and they will request drag-along rights. You can be forced to sell when the founders do. As a minority holder, it is unlikely you will receive any preference or other rights. And this is best for both you and the company. You should read and understand the shareholder or operating agreement of the company to understand your rights. 2. Dilution. Expect to be diluted alongside the founders in any fundraising round. If you own 1% and the company issues a 20% stake to a group of investors in a funding round, your stake will be diluted to 0.8%. Most tech companies raise multiple rounds of financing with a 20 to 30% dilution each time, earlier rounds being typically more dilutive, and later rounds being less so. Also, expect investors to get anti-dilution protection and liquidation preferences. The former could end up massively diluting your stake in the event of a down round, and the latter could prevent your stake from having much or any value in a distressed exit or soft landing scenario. 1. Is it worth it? The harsh reality is that most startups fail, and it is unlikely that your equity will be worth something. If you really believe in the team and opportunity, then go for it. But don't expect to see a huge windfall. TechCrunch pins the average tech company acquisition at around $200 million. But we'd guess the median is in the low tens of millions for the 10% of companies that return at all. In most cases, cash is king, and unless you are building a portfolio, you may be better off offering your services at a discounted rate or with deferred post-funding compensation. Private equity and the firms that manage it can help companies raise capital, improve their performance, and ultimately increase shareholder value. As PE firms go after bigger and bigger deals, private equity consulting can help those firms make the smartest investment decisions and yield the highest returns. After evaluating hundreds of investment options, general partners at a private equity firm must narrow down the viable options to the best few. What the best means depends on factors like industry trends and a portfolio company's market position, stability of revenue, and a potential for growth. A consulting firm can help with the research, data collection, and analysis required to make an informed decision. What are your thoughts about it? Thanks for watching.